Hey guys, welcome back to the Capital Mindset Show. So I'm just on a roll here, so I'm just going to keep going. So we're going to talk about Opendoor Technologies. So Opendoor Technologies is a company that focuses on buying and reselling homes. So in that category, I just want to state that I didn't like it when Zillow was doing it, so I might not I might have a bias against Opendoor. So I know it was requested. This was requested many times, and I'm only just getting to it. It has nothing to do with the votes of what happened last week. So the other videos that are coming out regarding the vote, you should be seeing those as well. I will say that Opendoor, we're going to go over some of the nuances. Of course, we're going to start off with the investor presentation and see kind of the sales pitch. So here it is, and we'll move us there. So with the sales pitch, we're going to see what they got going for them. So transactions, they have a greater than 160,000 transactions, net promoter score, so people like it. It's easy. Real seller conversation, 35% and up. Revenue, okay, 5.15 billion. Okay, but the revenue is going to look high because they're selling homes here. These are things that are, hundreds of thousands of dollars here. Contribution profit, though, is 332 million. So we can kind of see from that how much is coming. And then adjusted net income is $99 million. Okay, so is that a real net income? Is that adjusted? Well, it is adjusted, but is that real? So massively highly fragmented market. Yes, because this is a very fragmented market. So the proposition of Opendoor is that technology is better at buying and selling homes than us, than people. What I want to say is, just like how it is a fragmented market, there's a kind of a reason for that. It's because it actually is very difficult to actually understand the market that you work in, let alone understand multiple markets all at once. So I'd say that you can become very good at understanding your market, but then when you go into a different market, it becomes very difficult, or not the same factors apply, because there's so many other things that actually play into a part. So even at work, for example, when we're dealing with the local market for real estate, for commercial real estate properties, more recently it was in warehouse space. So with warehouse properties, they're fairly unique. I think they were fairly good in the area where we are, and so. But in a different part of the country, it might be different. So then you have to adjust. And if you don't make those adjustments and you kind of do a one-size-fits-all approach, things can get bad fast, especially if you become what is known as the buyer of last resort. You become the market maker. And that is a threat that Zillow faced. And in my opinion, I'm happy that Zillow is out of it, but Opendoor, that's basically what they do. Now, this company was promoted by Chamath Palihapitiya, that dude, and my problem with Chamath is that Chamath is kind of like, I'd say, do I dare say it? I don't know. Do you guys think he's a grifter? I'll let the audience decide. The audience, you guys tell me, is he a grifter? I won't say whether or not he is a grifter. But this individual was the one who kind of pushed this stock. I think it was SoFi as well. And all of those stocks are not doing too hot. SoFi, we already discussed on the channel, more speculative, if anything. And yes, and the bullish thesis around SoFi is kind of weird because it doesn't make sense too much to me. But Opendoor, I can understand it. It sounds fascinating. The idea that you could use technology to actually buy and sell homes more efficiently, because there are these inefficiencies that exist in the market. And a long time, people have been studying the real estate market and studying the inefficiencies that occur, the arbitrage at times that can occur. And we call it kind of like a form of micro arbitrage. So in macroeconomics, we have microeconomics, right? Micro arbitrage. So you might find a home in one neighborhood that is selling for X amount, and real estate agents will talk about all the time. And then the same home or similar home in another home selling for a lot less. And not always are they the exact same thing, just selling for different prices, but sometimes they are. Opendoor is trying to close that down, because there is an opportunity to be had should they have the ability to close it down. So over the past 5 years, they are down. Well, I don't know if they've been IPO'd for 5 years, but they're down about 40.35%. Over the 1 year, they're down 58.92%. Year to date, they're down 56.74%. And I think in the 1 day they're up this amount. They're down 7.12%. Okay, so. Of course, the price has de-risked significantly. So if you were looking at the stock and you're like, if you were looking at it, I don't know, what was the price before, whatever this was, $23, it has severely de-risked well, severely is a bad word, but it has significantly de-risked from that price. But the question is, does that mean that there's not that much risk going forward? Well, I don't know. We'll find out together. So going back to this investor presentation, they have a proven playbook for growth at scale. I don't know about that. Attractive unit economics. Okay, show me the numbers. Durable financial and I haven't seen this yet, so they could prove me wrong live on the show here. So massive fragmented market. Okay, show me this. Okay, so they see this. I get this. Real estate. Yeah, you're showing me a big thing, but you got to tell me, why is it fragmented, right? Because it is fragmented because the regions are so different. It's just a very it can vary vastly by region, okay? So complex, uncertain, slow, human intensive. Yeah, you can see like these all create inefficiencies that Opendoor is arguably trying to get into. That's academically speaking, the theory behind this. And that's in theory. We all know that sometimes things play out in theory, but in practice, they don't play out that way. Today, 89% of buyers and sellers use an agent, and this is their experience. Okay, so, I can feel that. All right. Retail, groceries. Okay, so they're again talking about that. Opendoor has less than 1%. Carvana uses the same metrics, actually. And I'm going to move myself a little bit. You can see Carvana is 2%. Yeah, but Amazon, I love how they're putting Amazon in the same thing as themselves. Superior consumer experience. Okay, so superior consumer experience. Okay, they have an app, easy to use. Cool, I like that. Simplicity, certainty, speed. Okay, cool. I can get behind this. All right, but I want to see the other stuff. High NPS. Okay, cool. High conversions. Okay, 80%. Okay, without agents, so you basically save on that. Highly differentiated, purpose-built platform. Okay. Cool. Product pricing, operations, customer. Okay, just the same stuff. Pricing, fully automated systems enabling at scale. So basically, it's just automated. Okay. Offers are automated. Okay. Total offers by year. Okay. Okay. Serviceable market is 590 billion. All right, cool. Virtualization. So they brought it down to 40 minutes. All right. Automation, buzzword there. Centralization, buzzword there. But that looks good. Okay, so yeah. Okay, so they're basically becoming more efficient. Centralization, more efficient. Proprietary software, operational efficiency, more words, efficiency. So they're more efficient than the traditional agent. How did they measure this? Oh, by transactions. Well, of course you're going to close more transactions. You're just everywhere. And proven playbook for growth at scale. Prove it to me. All right, growth at scale. Here we go. So they have 48 markets, 1.9% of market share. They're saying there's a lot of opportunity. Every time they say that word, it means they have a lot of opportunity, or that's what they're trying to say. Well-honed market launch playbook with a track record. Okay, but show me. Okay, geographic expansion, but show me the numbers. Show me the money. A well-established acquisition playbook, 1.9% of total share, cohort. Okay. All right, so they're basically growing share. They're growing share. And cool. Okay. 50 billion in revenue. On track to reach 50 billion revenue. I know that 50 billion sounds like a lot, but remember they're selling homes. It's about the profits here, guys. So they're not. Yeah, but the fact that they're not showing like the profit, if I was them, I'd be highlighting the profit per home that they sell on average, and then I can, kind of gauge from that. But the fact that they're not showing me that is kind of a red flag for me. Attractive unit economics. Okay, here we go. It should be here. If it's not in here, I'm not going to be happy. So reduction in resale costs. Okay, so you're becoming more efficient there. Lower acquisition transaction costs offset by services. Okay, cool. Limited contribution from increasing spreads. All right, cool. Where? Okay, contribution margin 6.5%. Thank you. Okay, so that they improved it from 3.5%, so they are increasing the efficiencies there. You see the spread, the acquisition cost, the holding resale. Okay, so improvements are so basically what contribution margin means is when they sell a home, 6.5% of the home's price is supposedly coming down to the bottom line. So because they're saving on all these other costs, the traditional contribution margin was 3.5% back in 2018. With these efficiencies, they were able to increase that to 6.5%. But that's 2021. How is 2022 going to fare? We know that we're going through a liquidity crunch. We know that lending is drying up. How is that going to fare? We also know, I also want to report something that I did post as well, is that April sales data was showing that new home sales were actually down a lot, And what just came out today was that a lot of people are bringing their home up to sale on the market because they're panicking because they want to get the prices now. So we just discussed this in the live stream. It was hilarious that the news actually comes out after the live stream. It's like CNBC or these guys are just watching us. But now they're talking about how we might be seeing a reduction in sales price, which might make or is making the builders a little bit more nervous there. And that reduction in new buy sales, or so new buyers coming in, and the reduction in lending growth will lead to, in the future, a reduction in home prices. And I think a lot of bigger YouTubers are now starting to talk about it too. But they've just now started talking about the liquidity crisis, or liquidity crunch, as we've been calling it. So how that culminates into Opendoor here brings a little bit of a concern here. Now, remember, again, I've said this, a part of me, now that everyone's talking about it, makes me feel like it's getting more and more priced in. We're probably getting to the point where while they are starting to get bearish, I start to get a little bit more bullish, because now the prices are, I think, in some of these assets really cool. Now, with Opendoor, I'm not saying that Opendoor is at a good price point, but again, it is de-risked. Now, I don't really like this business type, so I'm already biased, but I'm trying to be unbiased. I hope you guys can kind of see that, and I hope you guys feel that I am being a little bit unbiased. Okay, I'm trying my best. Okay, so looking down here, we do see unlevered, levered. Okay, so what are we looking here? Okay, so illustrative unit level returns. This is exactly what I wanted to see. All right, awesome. So levered returns, they can achieve 120%. Unlevered, they can achieve 20%. Levered, of course, is a little bit more risky. Unlevered is less risky. So what's going on here? So they take an acquisition price, $350,000. All right, I get that. Contribution margin, 21%. So contribution profit per home. So they make $21,000 on that, and that's about 6%. Contribution profit per home after interest expense. Okay, so 6%. Annual contribution profit. Oh, okay, so they annualize it. That's how they're doing it. They're annualizing it. All right, so then that annualized return is 20%. I get you, because you're doing it very quickly. And so note, we want to read these notes down here. So assume an annual inventory turnover of 3.65 based on holding period of 100 days. Okay, so that's how they're calculating it, because they're then calculating as an annualized basis at 20%, and the annualized basis is 120% if they leverage it. So if they put, for example, asset level financing, if they finance the home for $297,500 and they only put $52,500, then they can generate 120%. Very risky. Could be bad, but could pan out. All right, durable financial profile. Okay, so market cycles. So let me see what this is saying. Revenue, okay, 83% CAGR. Okay, cool. You're selling homes though. Homes acquired. Well, be careful with that inventory, but they have 42,334 homes. We're going to see them on the balance sheet. Adjusted gross profit. Okay, that's up. Contribution profit. That's up. Now, what about that net income though? Show me that net income. All right, so adjusted operating expense as a percent of revenue. Okay, so that is coming down. Adjusted EBITDA. Okay, that's going up. Adjusted net income. Long-term metric, I think, stands for, latest 12 months. Latest 12 months, not long-term metric. Latest 12 months, so they just hit break even. Okay, so they actually are improving this business, which is very interesting. But we have to remember the context of what we're in. I have one company in my portfolio that has done absolutely amazing. That is kind of the counterplay to this. It is entirely the antithetical position for this thing, okay? And it's doing very well thus far. I won't really talk about it, but yeah, that's all I'll say. Robust risk management framework, dynamic and responsive pricing, diversified risk management benefits, centralized decision-making, human oversight. Okay, cool. I don't want to really care too much about that. 35% of our inventory is under resale contract at any given time, reducing. Okay, so that's good. Okay, that's what I was very scared of. I was very scared of that because, okay, so at any given point, well, it's only 35% though. So at any given point, they can just sell it. They won't get the best price for it, but they'll get it out of their books. Okay, so that's all well and good. I like that. All right. I don't know who they're selling to, but yeah. All right, so strong track record of managing through an HPA environments. Okay, so let's see here. Let's see here, typical stronger. Okay, I mean, it's all well and good. They're improving in this year. 2022 is a better year. 2021 was a better year. So again, they're just showing us that they're getting better in every metric. Uh, okay, so they're showing us a global financial crisis. What happened? All right, all well and good. All right, so let's see here. Okay, how are they equipped? 2 billion, 2.8 billion cash equivalents, non-recurring asset backed with debt facilities, in-home purchase capacity, so 35 billion because that's leverage. They do have some debt here, and they have senior revolving loans, senior term loans, and mezzanine loans. That's fine. It's not crazy, but it's fine. Diversified base over 30 lenders. Okay, so they're not going to run out of liquidity. That's a problem sometimes with these guys. Okay, so their targets and some of these. All right, so let's actually go to the 10Q. In the 10Q, we're going to see the assets, right? Marketable securities, cash, restricted cash, escrow receivable. This is what I was looking for. So inventory. Inventory is actually down from December 2021 to March 31st, 2022. So my concerns are a little bit answered there because they are reducing inventory in a time where we're getting into a liquidity crunch and when prices got a little bit crazier in the first quarter. Now, I do expect them, if they were smart, they'd be reducing that inventory, which they are, and then they can probably increase that inventory later down the road, which might be very close, and they might see that too. So this kind of corroborates that if they're thinking like what I'm thinking or what a lot of people are thinking now, that potentially, and what the data is showing, that potentially we're going to see a bit of a drawdown in about 6 to more months, maybe a little bit sooner, but I don't know. My thing is like 6-ish months, and that's when my wife and I are going to be pouncing, hopefully. So we're definitely going to try to find some properties around where we live and accumulate some assets. Everything else, not too bad. Goodwill is fine. Everything else is fine. You know, everything's not. I'm not too crazy about it. Now they have a positive net income of about 28 million. The growth rates are still expected to be exuberant for this company, but I don't know. When I was taking a look at some analyst estimates, I saw ranges from 50% to 40% to 60% to 30%. So we can kind of gauge with that what we think. And I keep going on that menu for some stupid reason. All right, so statement of cash flows. Okay, we do see cash provided by operating activities. We got to be careful with this number because real estate inventory is a big factor here. You see that right there, and I'm blocking it. So if you take a look at that number, 1,416, that 1.4 billion in positive cash flow contribution is coming from the sale of homes. We talked about this in the Zillow videos. When Zillow was exiting the business, I told you guys that Zillow's cash flows will look high, but they're not really high. It's because they're selling the properties. They're getting rid of inventory. And then that looks positive on the cash flow statement. So you want to actually normalize for that and kind of consider that that's not probably the case. However, that being said, they are showing signs of efficiency. The GAAP net income in this instance is probably going to be more accurate, go figure, at telling us the actual fundamentals of the business in this case. So I'd say that while the business, I admire it for improving, there are a lot of questions that I have for this, okay? And there's a lot of uncertainties I have for this investment. I personally probably would not be buying this company, but, you know, that's my opinion, right? You might disagree with me on that. You might say this is a good business, but that's what makes a market. So we're going to have that disagreement, and that's perfectly fine. So I'd say that plugging this in and making estimations, they're going to be as good a guess as any, by the way. But I mean, we could try. Like we could try. So if we were to put OPEN. So open, and let's see kind of what analysts will have to say and all that jazz. So let me actually move this so we're right there. Okay, so analysts do have a price target of $11.72 and implying a 79.91% upside. Now this is, go figure, it's part of the real estate sector. Cool. All right, so we are going to actually state that they're going to achieve a longer term profitability, and we're going to say no to this. We're not making any adjustments, and we're going to actually change this to a yes, and they're going to achieve a long-term profitability measure of about 6%. Okay, if this were to be the case at the present moment, it is probably egregiously overvalued. Okay, that's what the model is basically saying. Because the growth rate simply is not enough to justify the current price. Okay, so based off of current prices, I would say, and one more thing. it's also taken into consideration the fact that it's probably at risk of bankruptcy here, or not unknown. Sorry, not at risk, but it's unknown. So it's actually can't tell, which is kind of rather interesting there. But if we lower this down, by the way, to about, let's say they achieve it in 2 years, and we're being a little bit optimistic there. In that case, we do see a buy price of about 20%. But you see, I pushed that out to 6 years. So let's see what happens if we push it out to about 4 years, and then we grow this growth rate to what's the higher analysts were saying at about 50%. You can kind of see that's a little bit much, right? That's a little bit much. So I think that this is perhaps more of in line with the potentials. And then from here, let's do 20. Oh, sorry, not 20, 25, and then 20. And then you see, I'll just keep it at 15 because now it starts to actually become a negative value. So basically, if it grows too slow, the value is just not there. It's just not there. It has to grow fast. It has to grow fast, and it has to achieve profitability quickly. That's what you're looking at here. The market is now pricing in all that risk. Okay, so what I will say right now is I'm looking at what appears to be a very high risk, high reward. If something pans out that the market doesn't see, but you saw, then you might do very well in this company. But the market is telling me, there's something here that it's not an attractive business model, especially in this environment. And the market is showing me that based off of the price movement or the price trajectory of the stock, right? It's not something that it looks so cheap because it went from 20 bucks down to $6. $6 is smaller than 20, therefore cheap. No. So we want to keep that into consideration when we're looking at this company. I know that it's very exciting because Chamath Palihapitiya is all over this company, or was all over this company until it fell down, and then now he's not all over this company. Just as the same thing with SoFi. But, we can call him out on that. Again, I'll let you guys decide, is that guy, what he is, but whatever. Whatever. Okay, so again, just to reiterate, if the profitability comes out too late into the future, it reduces the value, all right? And that makes sense, right? And that's leading up to it. So it leads up to growing to 6%, but if it doesn't achieve it soon enough, it's not worth the time. And according to the model, it's also taken into consideration that the balance sheet is kind of questionable, okay? On that note, of course, you can just trust analysts and take that 79.91% price target, or sorry, increase or potential upside in that price target with utmost certainty. And analysts say it's a strong buy, therefore it must be a strong buy. On that note, guys, thank you guys so much for watching, and I'll see you guys in the next one. Bye.